Welcome to Veranda CA. In today's session, we are going to see about these tax treaties of whatever is there between countries. So, what is the need, what is the role, all this is what we are going to discuss in this particular session. So, when you talk about these international tax treaties, first thing we need to understand is there is something like we all know that there are courts in a particular country, right? Like in India, we have the High Courts, the Supreme Court, and all those things to decide on various income tax matters. Now, when you talk about this international court, that is when something has to be sorted out on a global scale. What should be followed? So, there is something called International Court of Justice. So, this International Court of Justice becomes the relevant court for international arbitration. So, that is issue between countries. When there are issue between countries, this comes into the picture. Now, what do they consider as far as this the Court of Justice, the International Court of Justice, what do they consider while delivering a judgment? So, what do they go by? What are the basis in which they make their decisions? The first thing that they talk about is the International Convention, which is there would have been already an established set of rules in place, right? So, for example, each country, for example, India has this Income Tax Act and income tax rules. So, similarly, each of the country will have their own set of rules. So, whatever rules which are recognized by the contesting state. So, if India is having issue in the International Court of Justice, the laws adopted by India against the country that they are adopting. So, the rules of that particular country. So, that is what is the first thing. So, they look into this international convention. The second thing is international customs. When you say customs, we don't mean this customs act which you are talking about, the customs excise, not that. The customs is basically something like ritual, right? Ritual, like something like which you do on a regular basis. So, whatever has been generally accepted, what is being commonly practiced, so that law is also considered. So, whatever is the law that is generally in practice, so that is also considered for the purpose of this International Court of Justice. The third is the general principles. Forget the law as such. Every nation that is a civilized nation will have a set of guidelines or principles that is followed by default. There need not be a law or something. So, something which is recognized by default. So, for any civilized nation, there is that are by default set into the rule of land, right. So, it is by default applicable to such countries. So, such things is also given importance. And finally, the judicial decisions. When you say judicial decisions of that respective country, if that respective country has various judicial decisions, so that country's decision will also be given importance. So, what has been considered there in that particular court of law, that will be adopted for the International Court of Justice also. So, that is what we are calling as nation. So, that will be also serving as a additional role. So, when we said this judicial proceedings will be followed, not that they would have just adapted or something of that kind, but it will serve as an additional thing, because at the end of the day this International Court of Justice is above the Supreme Court or High Court. For such law, this will serve as a subsidiary means, that is it will support the determination of rules of law. So, whatever has to be adopted for this particular International Court of Justice, this judicial decisions of that respective country will be adopted, will be followed by this International Court of Justice. Now, when you say international law, in India we have this Income Tax Act, we have income tax rules. When you speak about global phenomenon internationally, is there something, we said there will be established rules in respective state, but there must be something governing this overall law at the international level. So, what is that? So, the Vienna Convention on Law of Treaty. So, this becomes the basis for the entire let us say the rules, everything for the entire the globe as a whole. This Vienna Convention becomes the basis. So, this is the basis in which everything else is set. Every other law that is being set, the treaty or whatever we are going to talk about, whenever it comes to international practice, it is all based on this Vienna Convention on Law of Treaties. So, any country can automatically adopt this Vienna Convention on Law of Treaties and just say that this will be applicable for the cross-border requirements as far as our country is concerned. So, this will be the basis for any cross-border transactions. And the next one is the relevant double taxation avoidance agreement, the one we called it as DTAA. So this DTAA is applicable between countries. So for example, we said Vienna Convention is a global phenomenon. It is a general principle. So it is something like a general principle across the globe. It doesn't change between countries. But this DTA is specific, that is country specific. So each country will have their own laws where they say, when you say law, it is probably a treaty and agreement signed between one country and another country, let's say India and US. These countries sign this agreement for what purpose? As we have discussed earlier in this DT relief and other things, basically to avoid double taxation, to create this harmony, for exchange of information. So for all these reasons that we have discussed earlier, this DTA becomes important. So this DTAA is also basis for this International Court of Justice. So this is also universally adopted. So each country will Vienna, it is for the entire globe, it is common. When I say DTA, it is specific to that country. Then apart from this, there could be anything which is adopted, that is what you call as customary international law, general principle of law. So whatever is generally adopted as a law, as something which has to be followed or something, will be adopted. So the general guidelines, the general rules, as we said, the customs, right? Each country have their own customs where they follow certain general principles. So such things is also applicable in international law. It talks about as a guideline for various transactions, particularly like transfer pricing, or we were also speaking about this base erosion, profit shifting, the BEPS thing. So such things could also be there. There could be other laws which is globally supporting, things like OECD, the United Nations could come up with various guidelines to undertake a particular transaction or set a principle in how a transaction as probably should happen. So that's what you call by customary international law and general principles of law. So this is about the International Court Justice, what do they follow and what are the international laws that are basically adopted by the International Court of Justice. Now going forward, when we talk about this double taxation avoidance, basically there must be a connecting factors of this the treaties and the transactions that is happening. So what is the connecting factor for the requirement of this double taxation avoidance agreements? The first is the DTAA could happen with the country or in that country. For when you say DTA, it is basically the transaction which results in this double taxation could have happened with a particular country. Let's say India could have had a transaction with USA. So we have had transactions with USA now or in that country. It could have happened in India. So basically this transaction which will probably result in double taxation or which has resulted in double taxation could be a transaction that has happened between India and another country, or it has actually happened in India. That is what we are meaning by with that country or in that country. In simple terms, we are trying to say that there will be two countries involved. One of the country will be that with that country, another country will be that in that country, right? Of course. So that's what we are going to talk about. From Indian perspective, when a transaction is between India and USA, it is happening with a country called USA, it is happening in a country called India. So that's what you are saying. We are trying to say that at least two countries will be involved in this particular transaction where this DTA will be involved, might be subject to DT, the double taxation. As we discussed earlier, as we have already discussed earlier, there is always two types of taxation. So that is the incidence of taxation. When you talk about this incidence of taxation, there is two scenarios. One is source based taxation, another is residence based taxation. We had discussed this in detail when we are talking about the relief provided, right? When we discussed about the relief provided, what sections, do you remember what sections we discussed about when we are talking about the DT relief? We discussed about section 90 and 91. It was also about 90A, but we will restrict to 90 and 91. So this 90 and 91 provides how do you provide a relief, right? We discussed about this. When we discussed this, we discussed about the reason why this double taxation arises. What is the reason for this double taxation? Because a particular transaction might give a situation to tax impact when because of the source impact or because of the residence impact. So what happens, it will be either taxed in the home country. So it will either be taxed in the home country on residence basis, because if India is having a transaction with the USA, Indian government will say, the Indian income tax act will say, see, you are basically an Indian company, you are a resident here in India, so you must pay tax for incomes earned outside India. So this is what the Indian rules will say, right? So that is how it works. So that is what we are calling by residence based, because that works on residence. Now, and host country on source. So the country which is basically giving a rise to the transaction. In our example, we said India and USA. So the USA is the receiving country where that is giving the rise. So USA says only because of me you have earned that income, pay tax here also. So that is because of the source. So that's what we are calling by source basis. So it will either be taxed on residence basis or on source basis. What happens when I say with another country? When I say with another country, we said two countries should be involved. So let's say that one country is that with another country. In again going back to that example, when we said India and USA, we are having transaction with a country which is USA, that is with another country. So in that country, it is taxed in home country alone and not on host countries. Something like your export of goods. What happens in export of goods? When you are transacting, when you are exporting goods into USA, you are earning money in India only, it is an Indian source. So you are a resident in India, it is taxed in India. So what happens is, it only taxed in the home country, that is in which you are resident. So it is on residence basis. So such example is this export of goods. Whenever there is export of goods, USA will not say you have sold goods here in USA, so pay tax here. So that generally doesn't happen. So when you say with another country, it is taxed in that home country and not on this host country. And when you say this in that country, where basically when the source arises in the other country, as we said, when will it be taxable in this host country? Only when you prove that source. So what is basically a source? Let's say we spoke about concepts like significant economic presence and business connection, which will give a source, which will give an information that it is deemed to accrue or arise in India. We spoke about section 9. So where it says transaction might be deemed to accrue or arise in India, in that case the host country also will have to pay tax. So that is what we are calling by the business connection, or in international terms we call it as what? Permanent establishment. So in international terms we call this as permanent establishment. Specifically in India, it has been defined as business connection in section 9, subsection 1 and clause 1. And it also includes a significant economic for certain transactions, such as your advertising, marketing, and certain such specified transaction, your significant economic presence also comes into picture. So what happens because of this? The tax arises in the source country. The source country also will say pay tax here. So if a particular transaction is supposed to be deemed to accrue or arise in India, the Indian government will say, see, you have had a business connection here, you have had a significant economic presence here, so please make the taxes in India. So this is what will happen. So it gives arise because there is a source in that particular country. Already they might be taxed in that home country because of residence. So it might result in what? Taxation in both countries. So there is a overlap. So there is a juridical double taxation. When you say juridical, it is basically between jurisdiction. So it also gives rise to a tax scenario in India. It also gives rise to a tax scenario in USA. So in this case, there is a overlap. There is a taxation in both the country for the same transactions. To support this, what have we discussed about? We have discussed that there is this concept of double taxation avoidance agreement. In case if double taxation avoidance agreement is not there, you take it under section 91. If you actually remember the words, we discussed about two concepts. What if there is an agreement? What if you don't have an agreement? So what if you have an agreement? It is discussed in 90. We call that we might have a double taxation avoidance agreement with that country. What about section 91? For 91 you say there is unilateral. We said that there is no double taxation avoidance agreement. So 90 and 98 is about bilateral, whereas 91 is about unilateral. So this juridical double taxation is because that there is an overlap between the taxability in both the countries, in our example, both in India and the USA. So this is where it gives rise to the reason for having a double taxation avoidance agreements, or a procedure to provide foreign tax credit to the tax which has been suffered in both the countries. So that's the reason for this agreements and all those factors. So that is what is important. Then when you talk about this double taxation, it need not be necessarily because of the source and residence only. There could also be something like economic double taxation. When you say economic double taxation, it is a transaction, it is the same transaction, but it is entered between different persons across the country. So when does this happen? The legal owner of the one transaction and the other one will be a beneficial owner. So there will be two persons, one will be a legal owner, one will be a beneficial owner. So what happens is there might be a scenario for the same transaction, both of them might be taxable, that is the legal owner and the beneficial owner. So this will result in an issue. So what happens? So this is another reason why you need clear-cut international laws to control various factors. So this economic double taxation is also one of the important factors. Another concept of this economic double taxation is basically when you are distributing the taxes, it must be equally distributed between the country. Only then it is economically balanced. We saw that in transfer pricing also when we discussed about this concept called arm's length price. We said one of the primary reasons of this arm's length principle is creating an economic balance. So there is an imbalance because of shifting profits. You are trying to bring in an economic balance. Similarly, in this economic double taxation, by distributing the taxes between the countries, so you are giving what is legitimate or what is the fair share of that other country. So you are letting them take their share. So this distribution of taxes is also one of the reasons. So this economic double taxation is also a connecting factor for the reasons of such agreements and treaties that we are talking about. So when you talk about these tax treaties, if you actually look about it, what is this tax treaty? So what is actually a tax treaty? This has been defined in Article 2 of this Vienna Convention, the one which we said it's the basis for all. It's the base for all the countries which is following this Vienna Convention law. So this becomes a common guiding principle across the globe for cross-border transactions or related issues. So what do they say? They say it is an international agreement. The tax treaty is basically an international agreement between states. When you say states, what they are referring here is not the states in Tamil Nadu, Maharashtra, Andhra Pradesh. What the Article 2 refers here is not something like your states that we are calling here in India. These are countries. When you say states, these are countries. So it is India, United States of America, United Kingdom, Australia, all these things, right? So these countries. So it is concluded between states. So let's say India and Australia are signing an agreement, an international agreement, then it falls under the concept of tax treaty. And what form it is, of course, since it's a legal thing, predominantly all legal documents or something should be in written form, right? So it has to be in written form and governed by the international law. So governed by the international. So we said there are guiding principles. We said there are this Convention of law. So it should fall within the base concepts of this Vienna Convention law. Then we spoke about concepts like the treaties designed by OECD, the treaties designed by the United Nations. So it must fall within this concept of this international law. It must come into that same probably what you can refer is same understanding. Whatever international law's objective is, the objective of international law must be captured in the essence of this agreement also. So that is what you are saying, that governed by the international. So overall it is governed by this international law, that is your Vienna Convention law or any other customary international law that we are talking about. Or two or more related instrument. What do you mean by this? When you are forming this agreement in written form, it could be one single agreement, as you call it as double taxation avoidance agreement, or it could be multiple agreements which is interlinked. So let's say you have something called double taxation avoidance agreement, then you have something called exchange information agreement. So there could be several agreements with the same country itself for achieving various objectives. So your objective could be different. So depending upon the objective, you could have one or more related instrument and whatever its particular designation. So whatever you call it, whatever you mean it, it could be one or more, but at the end of the day, it must be an international agreement that is concluded between states in the written form and governed